Today on the final bar, we'll talk market pullback. After 2 days of closing into strength, today we close more into weakness. So we'll talk about what this means from a couple of different angles. We're going to look at the big picture from a technical perspective, look at sector rotation in our sector setup segment. Then also my guest, Scott Smith from briefing.com, is going to help us think a little more bigger picture about valuations, other metrics to help us understand, put this week into context. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us every weekday after the close to look at the markets from a technical perspective, think about the charts, and then most importantly, connect it to the big picture, connect it to the long term. It's so easy in a week like this one and a week like last week to get so caught up into the short-term movements, the increased volatility, that we lose track of the big picture. And since we've been in such a continued uptrend, now we've got some interesting price action to sort of deconstruct, to debrief on and think through. And hopefully with our time today, along with yesterday, we'll start to put these pieces together, think about what a future direction might be, and make sure you're prepared for what may be coming next in the markets and in your portfolio. I did want to talk about some of the upcoming events here on Stock Charts TV and on this show, The Final Bar. Tomorrow, my guest is Jeff Weiss. He's a longtime mentor, friend of mine, technical analyst. And on the 5th, we have Javed Mirza from Canaccord Genuity in Toronto. On Monday, our next episode of Behind the Charts is going to feature a conversation with Brian Shannon from Alpha Trends. It was really, really interesting. He's wrote the book on multiple time frame analysis. His comments were fantastic. Then we're going to have some guests, familiar faces to many of you. Tom Bowley on the 10th, Aaron Swenlin on Wednesday the 11th. So we're going to get a number of different angles on the final bar, helping us think about what this action means relative to the long-term trends. I did want to point out, we have the Traders Expo coming up this weekend, going on in New York. Unfortunately, we had to cancel our trip to get out there due to all the events happening in Washington State right now, but we are going to be giving my event via streaming. So make sure you check out the website if you can get to it in person. I hope you can do that. If not, there are some really good streaming options, and we'll be providing some great comments about my presentation about how to deal with thinking about how you think as a trader, and we'll use some real-time charts to deconstruct some of those behavioral challenges we run into. Before we get to our market recap, I did want to point out the poll that we had running for the last couple of days. As a reminder, on this show, on the page, on the Stock Charts TV page, we always have a poll running for the most part. So take a moment, anytime you see it on there, answer it, because we love to hear back from you and use some of the material to turn it back and help illustrate where our thinking is. We asked you recently, what's the most important part in the process of understanding trading, the trading environment? And almost half of you said price action number one. I love that answer. And I also love the fact that number two was trader psychology. Then we get into sort of a tie between patterns and strategies, indicators and volume. And overall, Team Stock Charts TV, I think you did a pretty good job of pointing where the most important levels are. As we've talked about on the show, price is most important. And if I had one tool to help me understand what people were thinking about the S&P 500, it would be a chart of the price of the S&P 500. That's it. Because the price is what reflects the psychology of all the investors. Besides that, trader psychology, especially your own mental state, how you approach things mentally, makes a way more bigger difference than I think a lot of people realize. So thanks so much, everyone, for answering those questions. We have a new poll up right now, so make sure you take a second to answer those questions. We'll bring it up later this week on this show. Getting to our market recap. So yesterday was all about this huge rally coming out of the weekends, even though the news about coronavirus and everything had gotten a little, just less and less optimistic. It felt like the market rallied hard coming out of an extremely challenging week, obviously last week, one of the worst weeks since 2008. Today, we sort of maybe get back to reality, sort of a sell-off. What's interesting is the S&P down almost 3% the day the Fed comes out and does a surprise 50 basis point cut. And again, outside the scope of what we are able to talk about, I think on this show in terms of what it is, but again, for me, I would always come back to the fact that the market represents investor opinion, right? That is the voting mechanism by which people tell you what they're thinking about the market of interest. And so if the price is going up, that represents overall a more optimism than pessimism. And if the market's going down, it certainly gives more of a pessimistic feel to it. So I think, one of the challenges is the Fed coming out now in some ways probably validates the fears that a lot of people have had. Is this going to be more of a challenging period? The fact that the Fed has to jump in and feels that they need to do this might have stirred a lot of investors to think a little more cautiously, as opposed to alleviating fears that maybe has accentuated them to a degree. This candle pattern, I usually show bar charts. I switched to candle charts. So for those of you that are the candlestick aficionados, what pattern are we seeing here? We've referred to this actually a number of times because it tends to jump off the page. This is what we call a dark cloud cover. And again, I never worry too much about the names, but more the sentiment behind them. So yesterday was a big up day, closing at the highs, opening near the lows. Today we opened above yesterday's close, but we closed at least 50% of the way down through yesterday's body, the gap between the open and the close. And that is the signal suggesting short-term weakness. It's called a dark cloud cover. So, visually, you can think of the clouds kind of covering what had happened before then. So overall tends to be a little more negative than positive for the next couple of days. What's very interesting, and what I've always thought about candlestick analysis, when patterns happen around key levels, key support and resistance levels, moving averages, here we actually have both. So yesterday, the market got back above that Fibonacci retracement level around 3060. We've now closed back below it, also back below the 200-day. So switching gears, going more negative than positive. And again, the S&P holding that 200-day, I would argue, is one of those key levels to watch. So now I've sort of expected more more weakness. I wouldn't be surprised if we see lower lows. And for me, this 2825 to 2875 region, which lines up with these levels here in purple, I think is pretty key to be looking for. In terms of what happened today, let's sort of debrief on some of the action. We're going to get to some sector themes in just a minute, but at a high level today, we had a defensive stuff at the top: real estate, utilities, materials up there as well, but also consumer staples. So 3 of the 4 really defensive areas, a search for yield at a time when the Fed lowering rates, interest rates coming down. Big dividend payers are probably going to benefit from that. At the bottom, we have XLC, the communication services, financials, technology leading the way lower. We're going to look at that in a little bit, in particular when we talk about sectors and what that downtrend in tech means for us. Worth noting that bonds were actually up, though. They came off a little bit. They were up significantly about midday. Came off a little bit going toward the close, but still finished up 1.5% with the TLT, again, going to new highs. On the commodity side, gold, overall commodities sort of flat, but precious metals up pretty good. So gold and silver both about 3%, if not a little more. Oil pulled back a little bit, copper down more significantly. So, certainly the safer side, the more defensive side of commodities doing pretty well. I did want to point out some of the stocks that were on the move. So we're not going to have a ton of time to talk about them otherwise, but I am noticing a number of charts that sort of jumped out as I was doing my normal review. This is a bar chart, but if you know your candlestick patterns, this is called a bullish engulfing pattern, a big down bar yesterday on CME, 2 days ago. This is Friday's close on CME, closing below the 200-day for the first time since last spring. Then yesterday, a bullish engulfing pattern going back above the 200-day. And here we get the follow through going even higher today. So at a time when the market rallied pretty good, CME up over 3%, so leading the way higher. Now this is starting to feel a little more like that cup and handle top that it sort of felt like before last week when we sort of had the sell-off going into Friday. This resistance around 220, 222 is pretty major, and a confirmed close above that would certainly give a price and relative breakout to a stock like CME, which could be really interesting. It's sort of an interesting pattern, and an area in financials that have actually held up very nicely right now. You're also going to notice some other charts. I thought eBay was actually a really interesting one. This is coming out of a fairly depressed level. This is coming out of a support range from the fourth quarter. We broke to new lows going into the beginning of February, but then rallied very quickly into the upper 30s, then sold back down, and then we were back at the support level. RSI got right to around 40, which tends to be support in a bullish phase. But what I love is the relative strength, breaking to a new 4-month relative high this week, and today really following through to the upside. So certainly indicates some buying on weakness. And again, with stock like this, you'd want to see it reclaim the 200-day if at all possible, to sort of confirm that recovery. We don't have a ton of time to go through some of these other names, so I'd encourage you to look through the scooter movers, the stocks that have moved up and down today. Look at some of the themes that will emerge there, because I think you will find a lot of stocks starting to fan out a little bit, even though it feels like the market, quote unquote, is doing one thing. Remember, there are a lot of potential opportunities if you can dig one level deeper there. I want to move on to our next segment called sector setups. We like to do this occasionally to look from a sector rotation basis, sort of what's moving, and start to think about how that relates to the big picture analysis we just did. So overall, stocks had been rallying, sold off aggressively last week, a little bit of a recovery yesterday, actually a huge recovery, to be honest with you, but then back down today, even in the face of a Fed rate lower. So what is how does the sector picture relate to that big picture theme? So a couple things that stand out. This is the weekly RRG, the weekly relative rotation graph. And again, if you're not familiar with this methodology, we can't get too much into the details of it, but Julius DeKempener, my fellow StockCharts contributor, go to his show called Sector Spotlight. You can see it on this channel every Tuesday, or just go to our YouTube channel. You can see the previous episodes. He does such a good job at describing what this visualization means, but overall, up and to the right is positive. That's outperforming, solid momentum. Down and to the left, heading southwest, more negative, more weakening momentum, all on a relative basis relative to the S&P, which is at the crosshairs in at the 0 point there. What you'll notice is the XLK has been by far the outlier in a position of leadership, the strongest place. And if we just rewind just a little bit, you can see it's been progressing sort of northeast in a positive way for a while now, but in the last couple of weeks, starting to fade, it's starting to aim sort of southeast. And that still means the fact that it's furthest to the right still means it's the strongest place based on this methodology, but the momentum's starting to come off a little bit. If you look at it, the strength of that positive relative momentum easing a little bit. So less extremely positive, but still overall has been the best. The things that are rotating more negatively are healthcare, financials. These are the two that stand out to me, sort of heading southwest and coming out of that leading quadrant, rotating down toward the lagging quadrant. The XLE has been by far the worst place out of the 11 sectors for a while now, just continuing to go further down and to the left, suggesting you avoid until you see some relative support. But what is starting to work is interesting here. Utilities, real estate, both rotating higher. If we rewind, you can see how they've rotated really from a point of weakness here toward third week in January, really rotating to the improving quadrant. Now the XLU just getting to the leading quadrant, so far this week. So overall, you're seeing the defensive side of the ledger rotate more positive. Consumer staples now rotating more positive. Consumer discretionary, probably the outlier, being more offense, traditional offense, sort of moving in lockstep with some of these other more defensive sectors. But overall, the broad takeaway here is a rotation away from offense into defense, generally speaking. The next thing I like to do thinking about sector rotation is look at the candle glance page. This is looking at all 11 sectors and then the S&P 500 in the lower right corner. And it's just looking at them all over the last year, daily basis, 50 and 200-day moving averages across all of them. This is where you start to make some big picture comparisons. How many of these are above their moving averages? How many are below, which have just broken? You start to make some assessments based on that. So how many of these sectors are above their moving averages right now, the 200-day alone? The XLK is number one down here on the left. It's bounced off beautifully off the 200-day moving average, selling off today and giving a short-term bearish signal. But overall, one of the few sectors still remaining above the 200-day, has not broken below it yet. You had a couple like utilities, like healthcare, like staples, like communication services that had gone below the 200-day, but have now recovered a little bit. Real estate also in that bucket. And so you had things that sold off very aggressively, but now rebounding a little bit, and sort of right at that point where the question is this more of a V bottom, more of a continued upside, or is this just what we call a dead cat bounce, a sudden rally off of extremely depressed or oversold levels? And then you have the sectors that have not gotten anywhere near or have not yet accomplished that 200-day moving average. Discretionary jumps out in that case. Financials, materials, industrials, certainly in there. So have broken below a little while ago, a couple of weeks ago, have not gotten back above that key 200-day moving average. So suggesting more weakness than strength. And then energy, again, the outliers, the only one out of the 11 that is down below two downward sloping moving averages, which again, from a trend following perspective, says to hold off for sure. When I'm thinking of things like energy, it's all about where we're at relative to some of these long-term trends. And what I meant to do, sorry, was technology here. If we look at technology, I think when I'm seeing a broad sell-off, which is what we've seen, and then you see a quick rally like we have yesterday, and now we're sort of back in the middle of that. I like to look for lines in the sand. Look to key levels, charts that are starting to line up with some of the traditional support or resistance levels that might help us get a read on everything else, because things are really jumbled up as they're fluctuating so quickly. The 200-day, I'm sorry, the XLK technology jumps out to me as one of those sectors that may be giving us more of a clear, plain vanilla type of read on what's happening. So it's sold down to the 200-day moving average, opened right at it almost to the tick, but then rallied very quickly out of there, which certainly speaks to some strength. Not being able to break below the 200, that's a good thing. Testing support here from the beginning of December, so it's one of the few sectors that actually held at a key support level. Now rallying back up, and the question now, if we start to distribute, and this is also giving a bearish candle pattern coming down, I think the line in the sand is right about here. And some sectors are pretty disjointed, sort of all over the place with levels. The XOK strikes me as one of those that's at a pretty key level here. If we can remain above that 84.25, 85 level, which is the 200-day moving average, which is the 38.2% retracement level, it tells you things are holding up okay. On the weekly chart, it's going to look like it's still in a pretty decent uptrend, even though we may have established a lower high here this week. We'll have to see how things play out through the remainder of the week. But overall, that's a pretty good level to watch. Also, on a relative basis, this thing has been relatively strong. This is why on the RRG chart, it's the one out in the upper right corner of the visualization, because it's held up very, very nicely. It's outperformed, probably 17% year to date, so not too bad. So that is one. The other one I'll just point out, because it's a Fed decision day, is the XLF. And again, what concerns me about the XLF, it looks a lot like technology, but it's become much more depressed, making a new relative low for the year, testing long-term support around 26, 25.50. This is going back to the middle of last year. We bounced up yesterday, but now closing now back toward the lower end of that range. And it certainly feels to me like we're very quickly going to test that 25.50 support level. A break below that is a new price, new relative low, and suggests further weakness. So I think financials are certainly an area of concern at a sector level. We need to take a quick commercial break. We'll be back with my guest, Scott Smith from briefing.com. We'll see you in a minute. Hello, everyone. Welcome back to the show. I'm your host, Dave Keller from StockCharts.com. Thanks for joining us for the final bar every weekday. Please keep your questions coming to us on a week like this one and last one. There's always things that come out when you're looking at the charts. We are here to help you. So just shoot us an email, thefinalbar@StockCharts.com. Happy to consider your questions for one of our future mailbag segments. I want to bring on our guest, Scott Smith from briefing.com. Scott, thanks for joining us.
Hey, thanks, David. Appreciate it.
So a lot of questions right now in terms of, this pullback. How do we make sense of it? What I loved was you sent 3 charts ahead of time. The first one, if I'm reading this correctly, you are applying a technical indicator to earnings, and I'm dying to know what this is telling you about the environment here.
Yeah, it's pretty nutty. As a technical analyst and a devout swing trader, I'm not really one to deep dive into fundamental analysis, but it's part of the Wall Street machine that's out there that just drives everything, earnings all the time. So basically what we're looking at here is a long-term monthly chart of S&P earnings. And I found this a couple of years ago. I've been a long-time StockCharts subscriber. And if you take fundamental data and you put it in a graph form, I just can't help but draw a trend line on it. So for me, I started just playing around with this a little bit. And I think the data only comes out weekly on this. So I went to a longer term chart. And I just started noticing that these trends were available. So in the middle of the chart there is the actual earnings track trends itself. And you can see over the last 20 years or so, there's definitely been this cycle of up and down markets that coincide with the bull and bear markets in the S&P itself, which is at the top of the chart. So um, looking at it a little bit more deeper, I decided to throw a couple monthly moving averages on it, like the 3-month, the 6-month, the 12-month, and the signals started to become a little bit clearer. And then I look at RSI in the bottom, a 12-month RSI, and that's been an overbought state for quite some time here, suggesting that earnings growth is pretty good and valuations are pretty decent in context of this secular bull market. So things have come back in a little bit. You can see recently on the right side of the chart there, but it's at this tipping point right now. And we did have a similar signal that happened back in late 2012, right before the 2013 bull market, where things pulled back in a little bit, and basically it was crisis averted, and we wound up having a very strong bull market there. So from my bigger picture analysis here, we are still in this long-term secular bull market. We have very low interest rates. I think they just went sub 1% today on the 10-year. We have very low employment. We have very low inflation. And so I think even though we're going through this corrective phase because of the coronavirus spreading and the economic global slowdown, that the bigger picture is still intact. That doesn't mean we can't still fall further. And I think if we do, we come down around that 2,600 mark in the long-term uptrend of the S&P. But it's really going to be that earnings, watching this earnings chart here, basically go into more of a downtrend. That's going to have me concerned about the big secular bull market, and if we're going to go into more of a recession type of environment.
So overall, the long-term trend in earnings appears to be holding up. We
Yeah.
talked about sectors a little bit earlier on the show. What are you seeing in terms of sector rotation, especially now in a sort of dislocation with the markets? Tell us about chart number 2.
Right. So I'm a big believer that every cycle of a market is going to be led by one industry and probably underperformed by another. And in my analysis, this last leg of the market over the last year or so began back in December 2018. And if we just look, we could see technology clearly outperformed, and it's been pretty obvious if you just look at all the leaders and what's been overweighted in the S&P. Now, what's been significantly underperforming and underweighted by a lot of portfolios has been energy, and rightfully so. I mean, massive downtrends. A lot of these names are below key moving averages. Every rally's sold into. Crude oil has been selling off. You got all the details that just fit into that picture there. But with interest rates keep dropping lower, the Fed's trying to induce inflation. And if this coronavirus doesn't really play out into this global pandemic, or first off, if that happens, you won't even see me trading charts or anything like that. I'll probably be in bed somewhere, in quarantine. But
Right.
but for generally speaking, if does basically settle down and the market does kind of has already discounted the slowing growth, I think energy has to be a space you have to start considering in your portfolios. And the reason being, interest rates are so low. And take a look at the recent yields on ExxonMobil, Chevron, BP, Total, Suncor. They're all sporting yields in the 5 to 8% area right now. And if you're an income-seeking portfolio, this is starting to be an area that you're probably starting to look for, that you want to start nibbling on down the road here. Now, this chart here, this is another one of these gems on StockCharts that I've come across over the years. They actually have this for each individual S&P sector ETF. This one is the energy sector, new highs and new lows percentage. And again, if you just take a look at when the extremes happen over the course of the last decade, and in this case, basically drops below negative 30% or so, you can see that they coincide with temporary or more intermediary bottoms in the XLE itself. So if we go to the right side of the chart, we can just see that we're entering that very negative, aggressive, bearish phase of this, where nobody wants to own energy stocks anymore, yet they're sporting these really high yields. And I think that's, this is an area that if you've been ignoring this energy sector and just staying away from it, I think this definitely warrants attention to start nibbling on a little bit in your portfolio over the next couple of weeks here. And I think you'd be surprised at potential bounce and that you can make here.
Scott, those are three fantastic charts. That last one reminds me of a mentor of mine, Walter Deemer, who was at
Yep.
Putnam in the 1970s and the 80s. And he said, when the time comes to buy, you won't want to.
Yeah.
And
Oh, of
I
course.
think
Yeah.
your last chart of energy speaks to
Yeah.
that
Yeah.
mentality. But three fantastic charts and a great take on the market. Scott Smith, thanks so much for joining us today.
My pleasure. Thank you.
That was Scott Smith from briefing.com with a couple of really good charts, three fantastic charts showing earnings trends and the long-term trends. And again, the challenge with this sort of environment is putting it in relationship to all of that historical trajectory. And I think that first chart more than anything helps us remember that. We need to wrap up the show, ladies and gentlemen. Go right to the 3 in 3 charts in 3 minutes. If these are not on your radar yet, I hope they are from this moment on. We're going to talk a little bit about sectors and then get into a particular group idea. But first off is looking at consumer discretionary versus staples. We did our sector setups work earlier. Scott Smith, our guest, talked about technology versus energy and sort of the bookends of performance over the 11 S&P sectors. One of the things we like to look at is looking at consumer discretionary, the offensive side versus consumer staples, more of the defensive side. This ratio had been recovering pretty well if you cap weight it, which has a huge exposure to Amazon within the XLY because it's such a big market cap name. What's been interesting is on an equal weighted basis, if you minimize the impact of Amazon, actually the ratio has been rolling over for a little while now, for a couple of months, showing a rotation away from discretionary into staples, broadly speaking. What's happened now is those ratios are both at new lows. So the equal weighted ratio has now gone to a new low, illustrating more of a weakness or more of a defensive versus offensive posturing. I think it's also interesting to notice that even the cap-weighted version testing a new relative low with today's close. The second chart is looking at biotech. So again, I like to think about groups that are at key junctures, key themes, key story names that could be relevant. Obviously, a lot of eyes on biotechnology names and how the performance there will relate to the coronavirus and all the challenges. I think similar to what we saw with tech, we have a group here that's rebounded right off the 200-day moving average, actually holding up pretty well. However, this, and again, I feel like this is candlestick day. I keep coming up with interesting examples. This is actually called, does anyone know? It's called a bearish harami. I'm glad I studied for the CMT many years ago, and somehow I'm managing to remember candle terms. So that's good. But this is where you have a long up day, a long down day, but the real body does not eclipse the previous body. It's sort of an inside day of sorts, but it is a short-term negative. So looking for biotechs to go back down toward the 200-day moving average, but seeing if it's able to hold there could be interesting. And what's very interesting is the fact that the relative strength is testing a new 10-month high this week. The final chart we're going to talk about on the 3 in 3 is technology sector. We looked at this earlier. I've made it a candle chart just to show this bearish engulfing pattern. We had the jump yesterday, the big gap higher, but a down close that's going below the previous day's open. So again, we have a number of things sort of confirming today was more of a back to reality, suggesting a little further downside, at least for the next couple bars here. What's interesting here is looking at the relative performance of technology. This has been in such a good, strong, consistent uptrend. We've now put in a potential lower peak in the relative strength. And if the relative line would break below that low from the last week in February, that would be the first time in a long time going back off the visible area when tech has essentially gone to a relative swing low. It doesn't tend to happen. It hasn't happened in the longest time. At this point, it's still holding up okay, but that's the level I would watch. And ladies and gentlemen, that's our show for today for a Tuesday afternoon here in early March. I want to thank you so much for joining us every weekday after the close for the final bar. We'd love to answer your questions on a future show, so keep them coming. The final bar at StockCharts.com is the best way. You can also just put in a comment real quick on the chat window that you see on your screen, and the little Q&A panel. We'll capture those every day and make sure we include them anytime we can. Also, look us up on Twitter at FinalBar SCTV. You can see us, all of our historical videos, all of our previous episodes on our YouTube channel. Just look for the Stock Charts page, and you'll see the final bar along with all the great contributions from my fellow hosts. Ladies and gentlemen, for StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.